Welcome to Dorsey and Whitney's webinar on trading on the OTCQX, OTCQB markets for Canadian issuers. I'd like to introduce Chris Dirksen, a partner in Dorsey's Capital Markets and Corporate Compliance Group. Chris?
Hi, I'm Chris Dirksen, and I'm joined by Chris King of the OTC Markets Group and my colleague James Gutman of Dorsey and Whitney. Chris King leads the OTC's International Corporate Services Group and has assisted more than 1,000 companies to go public in the U.S. on the OTCQX and OTCQB markets. With more than 2 decades of financial markets experience, Chris has served in various roles at DF King Worldwide, Capital Precision, and Precision IR, helping hundreds of multinational blue chip companies achieve their corporate objectives. James Gutman and I are both partners at the law firm of Dorsey and Whitney in the Capital Markets and Corporate Compliance Group, practicing U.S. law from Dorsey's Toronto and Seattle offices, respectively. We are co-authors of the OTC Listing Guide for Canadian Issuers, a copy of which is available through the materials that you've been emailed for today's webinar. We're also co-editors of Dorsey's Cross-Border Counselor blog, which provides those U.S. legal updates that are of most direct value to Canadian companies and advisors, the link for which you can also find in the course materials. We both help Canadian companies with their U.S. cross-border needs, including cross-listings, public offerings and private placements, mergers and acquisitions, U.S. reporting, and other matters. A few initial housekeeping matters today. Participants will be muted, but if you have any questions during the course of the presentation, we encourage you to use the chat feature, which you should be able to access at the bottom of your screen in order to submit your questions to the panelists in writing. We'll try to keep the presentation a little on the short side to leave some time for Q&A at the end. If we can't get to all of your questions during the presentation, we will follow up with you after the presentation. Second, CLE and CPD credit is expected to be available in a number of jurisdictions. We will announce the CLE code in the middle of the presentation for those in jurisdictions that require one. And lastly, if you'd like to reach out to any of the presenters after today's presentation, our contact details are included at the back of the slide deck. I'll now turn things over to Chris King, who will get us started.
Thank you, and welcome everyone. Thank you for joining us today, and special thanks to James and to Chris and the entire team at Dorsey and Whitney for organizing and hosting. If we could go to the next slide, please, Chris. So the agenda, fairly self-explanatory. I'm going to take up potentially the first sort of 20-25 minutes or so, providing a summary of the OTC Markets Group and frankly, the role that we play in cross-border trading. As the bullet points mentioned, there's a variety of misconceptions or misunderstandings about what public companies can and can't do and how accessible they are from the US to trade the shares. So we're going to talk a little bit about trading. We're going to talk a little bit about market segmentation and what the different tiers mean, and essentially just provide best practice advice for companies and advisors who are looking to better access the US in a more cost-efficient and effective way. So hopefully a little bit of something for everyone on today's call. And then I'm going to turn over to Chris and James to talk a little bit more about kind of the legal implications, obligations, and how to apply and get set up correctly to trade in the US. And then as Chris mentioned, we'll go into Q&A towards the end. So next slide, please. So when people traditionally think about US and financial markets, naturally they think about NASDAQ and NYSE, and rightly so. They're two of the obvious exchanges to think about. But I would imagine, based on my experience and working with more than 1,000 companies, companies from all over the globe want to access US markets for a variety of reasons. It might be to raise money, it might be to garner more US investors, it might be to get more liquidity, it may be because they have existing shareholders or employees in the US. So a variety of reasons why companies look to the US. What's often misunderstood is the role that OTC markets can play, and specifically supporting issuers to achieve all of those goals in a far more cost-efficient way than just joining a US exchange. So OTC Markets Group is the largest ATS in the US, with more than 11,000 securities quoted every day. These are brokers, US brokers, who would be trading NASDAQ and NYSE securities. And they need a venue, a technology on which to be able to quote and trade, the companies that are not listed on NYSE or NASDAQ. And so we're really the trading venue of choice within the US for over 11,000 companies, or 11,000 securities, on which most of the major US financial brokers rely on every day. And you can see from the right-hand side, the total market capitalization over 18 trillion, with hundreds of billions of dollars on any given annual basis. So we operate in a highly regulated environment. We're SEC registered and FINRA regulated. But whilst we're not a stock exchange, there's a fundamental difference between being an exchange and a regulator than just being a trading venue. But certainly we're an extremely large and established stock market within the US. Next slide, please. So before I dive into market segments and trading and how all of that works, I think just to provide some context for the listener, mistakes that I hear or misconceptions around how markets work and how cross-border trading works are very common. So I'll just talk briefly to each of these, because if you are involved with a public company, it's probably safe to assume that you've either thought this in the past or perhaps heard someone say it. So for example, I think the most common misconception is that just because you're public in your home market and you're obviously, you're listed on an exchange and you spend a fortune and a lot of time to be public, right? You're transparent, you're shareholder friendly, you're reporting. That people believe means that any institution can buy that company's stock no matter where that company is listed. So this isn't a Canadian specific misconception. I hear it globally. There are many investors in the US, professional investors, smaller institutions, family offices. So you're talking, professional funds that are either unwilling or simply unable to buy shares that are listed outside the States unless there's some sort of conduit. And so OTC Markets fixes all of these pain points mentioned. But most US investors prefer or have to trade in US dollars. They have to trade in US market hours. And so whilst in many cases there's an intermediary required for these funds to purchase shares, as I said, we at OTC provide the solution that facilitates the trading flow. So the second point there, again, similar to the first, there's an assumption that because you're public in Canada, for example, that brokers and advisors can recommend you, can trade on behalf of clients. So think about the hundreds of thousands of financial advisors making investment decisions on behalf of the high net worth clients. You as the issuer need to meet the legal requirements in the US before those kind of transactions can occur. And so as market operator in the States, we obviously work with regulators and ensure that we can help companies get set up correctly to facilitate this order flow. So the third point there, just any US retail investor can buy on Canadian exchanges. This is often surprising for the management and board members of public companies in Canada. The reality is that if someone logs on to their E-Trade or their Ameritrade account, as you type in a company name, it's very often reliant on a US ticker symbol that appears and a US quotation is provided. And so, for context's sake, everything that we do here at OTC Markets on the international side is designed to help facilitate that trading flow. And a lot of my presentation today is going to focus on removing restrictions and just helping issuers get set up correctly. So a few of the other points on there, I'm sure you've read them by now, but you obviously do not need to list on a US exchange to be successful. We're talking about secondary trading. You're already public and you have your own regulator in your home market. You have high corporate governance standards and reporting. You do not need to list on a US exchange. It can be a good solution for companies in a particular scenario. But for secondary trading purposes, we are the trading venue of choice in the States. We'll talk a little bit more about pink and gray ticker symbols, or the pink and gray markets. I often see companies that see a ticker symbol and there's an assumption there that they're actually set up to trade. Maybe they see some volume print and they think that the plumbing is in place to facilitate trading. The reality is that certainly the gray market, and in many cases the pink market, actually represents a challenge for a lot of settlement firms. There's a lack of a public quotation, so there's no market making. And so we'll touch a little bit on that, because if you're at a company and you find out you're on the pink or the gray market, there's definitely some steps that you would want to take if the US is important to you. And I'll just reiterate a key point here as we navigate this subject matter. The SEC filing is not a requirement to trade on OTC. So we'll get into a bit more detail on that too. So next slide, please, Chris. So you may be familiar with some of the terminology here, the different tiers of the market, but they're highly relevant to companies that want to be successful in the States. So the top tier of our market is OTCQX. This is one of our two premium markets. So QB, our venture market, is the other premium one. And frankly, any company looking to the US that places any emphasis or importance on the US really should consider trading on either QX or QB. QX was created for the larger, more established companies. It does have financial strength, market cap, revenue or balance sheet requirements. And really, to summarize, I would say the rules were mainly written not for credibility or status purposes. It's really thinking about what the US brokers require in order to be able to make markets, to be able to settle trades, tolerance of risk. QX is as close as you can get to being a US exchange listed trading environment with the fewest sort of challenges or restrictions in place. So if you qualify, certainly QX is where I encourage companies to be. But the QB market has more than about 1,000 companies traded on it. It's really for early stage, smaller businesses that are just developing their US footprint. QB has proven to be incredibly successful as a stepping stone. So companies work their way up the food chain from QB to QX when they qualify, but QB is a really good environment. Both QB and QX are what a lawyer would term an established public market. We call them the premium markets, and they're really the only two markets that come with a variety of trading and compliance solutions to help service the issuer with brokers. And we certainly see better liquidity, more volumes, and a far higher level of engagement on those two marketplaces. Pink is possibly what you already know about Pink. It's an open environment. It does not require any engagement from the issuer. So brokers can trade a variety of different companies. So think about some high profile examples of bankruptcies in the US. So JCPenney and the car rental company Hertz, two good examples of companies that went bankrupt, left the US exchanges, and they have to trade on the pink market. If you're trading at fractions of a penny, or perhaps you're behind in your reporting, all of those companies are limited to the pink market. And so if you find that you're a company that is on the pink market, it doesn't make you a bad company because you're there, but it certainly indicates a degree of risk for the investors and the market participants. But most importantly for you, the issuer, it means that you won't benefit from news flow and a depth of book and greater liquidity and all the things that you really want when you're public. Next slide, please. I'll just summarize the opportunity here. I mentioned that I encourage companies to trade on the highest market tier they qualify for. we get asked in many different ways as to what the net benefit of joining QX is. We tried to take our bias out of this discussion, and so we did that by sending the names of companies who have joined QX over the last 10 years. So you're talking about 500 companies who have joined from a number of different exchanges. There's probably about 35 companies represented in the data set. And they obviously joined over different times, different markets, different industries and market caps. And the analysis that was carried out basically looked at the home market volume. So it's important just to reiterate that if you were to join the QX or the QB markets, the benefit, whilst you will see more trades print in the US, the reality is most brokers don't sit on the stock, and so they're not trading off their own book, and therefore the shares have to come from somewhere. So really the key benefit here is companies that join QB and QX traditionally see a substantial increase to trading volume on the home exchange. Clearly that depends on the company and their experience and success and news flow and everything else. We're not responsible for the execution of the strategy, but certainly switching the lights on and helping companies become more accessible tends to lead to substantial increase to home market volumes. Next slide, please. So again, there is a home market bias here. So it is important if you are listed outside the US to be quoted here, have a market here. Then I mentioned pink and gray having little to no engagement. We'll touch on this with some visuals later in the slide deck. But the other important thing here is I personally view paying for QX and QB as very much a compliance and trading solution. Many companies join for the visibility benefits and all the events that we host in terms of virtual conferences, CEO interviews, and market opens to get more eyeballs on a security. But I think blue sky recognition is a perfect example of how you create more efficient trading on QX and QB. These are solutions that don't come on sort of that aren't provided on lower tiers of the market. Blue sky, I'll explain in a little bit more detail, but essentially these are laws that are designed to protect the residents of each state. And in the US, there's 54 different sets of rules, right? One for every state and territory. And knowing that you, the issuer, are not going to be able to be traded by brokers who are making investment decisions or financial advisors making investment decisions on behalf of clients unless you meet the blue sky laws in each and every state. That's a good example of a bottleneck that's simply removed by joining the premium markets. Next slide, please. Next slide, please. I'll skip that one. Okay, so I mentioned the two key benefits of QX. I think it's number one is more efficient trading, more brokers, better liquidity, greater US ownership. Some of the functions that help support that you'll find on both QB and QX, that you get to post materials through a disclosure system. This is actually pretty important and something that perhaps we don't talk about enough. There is some SEC reform that is going to impact many hundreds of companies in Canada, potentially thousands of companies in Canada next year. So I'll touch on that in just a moment, but remember that if you're on the QB or QX market, you're posting materials to our system. Again, no SEC filing requirement. You benefit from a foreign private issuer exemption, 12G32B, which I'll let the lawyers talk about. But by posting materials here, you're considered engaged. You're providing up-to-date and accurate information and certifying that you meet certain standards on which US brokers can rely. Level 2 quotes are really important too, because really it's the brokers that provide the liquidity. So I want complete transparency as an investor into how many shares can I buy and at what price. Without that kind of transparency, it becomes a bit of guesswork. So that's where pink is particularly challenging. If I don't have level 2 quotes, how do I know how many shares I can buy and sell and at what price? It becomes problematic. Next slide, please. I'll just touch briefly on the trading element, because a lot of the time, again, it's the settlement mechanism that people don't understand. So on the left-hand side, you have an example if you join a US exchange. So from the top on the left, you've got your Canadian reporting requirements. Primary listing is in Canada. You join a US exchange, and that tends to suck the liquidity out of your primary listing. Naturally, being on a US market, if it's NYSE or NASDAQ, you take on the SEC filing obligations, considerable cost and liability associated with Sarbanes-Oxley compliance. And so for a lot of companies, certainly in the small, mid, and you could argue even the large cap space, the option on the right-hand side, QXQB, tends to work more cost efficiently. So you've got your Canadian requirements, which you'll continue to be obligated by. You continue to be primarily listed outside the US, and the shares just flow seamlessly between the two. So really all you're doing is opening the door to US brokers and US investors without taking on, again, the cost and complexity of another regulator and additional reporting. Next slide, please. So I wanted to just show some visuals very quickly. Again, the key point with this one is your public. So let's say you're Ivanhoe Mines, listed in Canada. Why can't US investors just trade direct into foreign markets? I can tell you, if I want to buy Repsol, I'm not going to go to Spain and open a Spanish trading account. I probably cannot. And I'm not going to fund an account in euros. So what we do here, this is a screenshot of my TD Ameritrade account. So a US funded brokerage account, obviously funded in US dollars. I type in Ivanhoe, you can see in the search box in the top right-hand corner, and up pops Ivanhoe Mines. Note, it's a 5-letter ticker symbol. This is the OTC US ticker symbol. The 5th letter is always F to indicate it's a foreign but ordinary share. So it's the same share that's listed in Canada, just a different ticker symbol. Next slide, please. Again, just visuals to help you kind of see the impact of being on a premium market. Ivanhoe Mines, it's on QX. Last year it was in the best 50 performers. But like I said, there's a disclosure system, they're posting news, and that flows through the US system. You can see that there's a series of information available to brokers and investors. Next slide, please. By contrast, the pink and the gray markets, complete lack of engagement and information flow. So in this case, there's no financials available for this pink company. Next slide, please. Again, compliance, blue sky exemptions. So by being on QX, Ivanhoe Mines was able to significantly increase its blue sky compliance. Next slide, please. So these are things that issuers, frankly, either don't understand or just happen to have sort of not heard of before. But the blue sky, by being eligible for blue sky clearance across the majority of US states, it is a very helpful solution to have. There's no one individual feature that companies look at and say, that's why I'll join a premium market. But if you look at most venture companies listed in Canada, you'll find that they don't get exemptions in the States. And so, yes, we're a market, and first and foremost, we're trading services. But the reality is that, just by joining a premium market here on OTC, you're going to significantly increase your blue sky exemption. This is obviously this is a pink company listed in Canada. Next slide, please. Visibility, I mentioned these are sort of nice value add functions of being a client of OTC. This in particular was, I think this was a consumer brands virtual event that we hosted. We run a series of these throughout the year, and on any given year, there might be 30 to 50 events. So yeah, Hugo Boss is obviously a very easily recognized household name, but there's many other companies, many of whom are listed in Canada, who want to come out and tell their story. And with the environment the way it is right now, and travel to traditional conferences restricted, our virtual investor conference series has proven to be tremendous value add, and some events have had substantially more than 5,000 presentation views. Next slide, please. Purpose of this slide was really just to elaborate a bit more on that visibility program. I mentioned CEO interviews, I mentioned market opens. We have a monthly newsletter on which we interview and profile companies. So again, it's nice value add to being on a US market. Next slide, please. So the current status of QX, I think we've seen over the last 2 to 3 years, substantial inflow from Canadian markets. Canada does represent our largest international companies. But I like to use the household names to create comfort. People may be surprised to know that Heineken, BNP Paribas, Repsol, Danone, Roche is our largest client at about 300 billion in market cap. This is not an exclusive club for multinational sort of blue chip names. Canada does represent our largest client base, and frankly, if you meet the qualification criteria for QX, then I would encourage companies to consider it. Next slide, please. So I just wanted to provide a brief summary of kind of the Canadian client base that we have. It really does represent a variety of different industries. And you can see at the bottom there that the difference in average market cap, I think is self-explanatory, right? QB is really designed for smaller, earlier stage companies. Next slide. So I'm going to just take 2 minutes and then wrap up quickly. I mentioned that there is SEC reform. If you are on the pink market, this is really the slide to pay attention, or the 2 slides to pay attention to. The way in which all companies are able to be quoted in the US, it doesn't matter whether you're on QX, QB, or pink. If you're publicly quoted here, the way in which that has been able to occur is that a broker clears a 211, which is a permission slip to FINRA that provides approval to a broker to quote a security. And after 30 days, that security becomes piggyback eligible, meaning that all brokers in the States have the option of coming in and making a market in that security. So the 211 could have cleared last week, or it could have cleared 20 years ago. But the overhaul of the 15C211 SEC rule, the most significant impact here is that that piggyback eligibility is going to be removed. And so the impact for Canadian, but not just Canadian, but all companies that are cross-traded from the home market into the US right now, the impact is going to be that your public quotation, if you do nothing, it will likely be removed in Q3 of next year. So there's no unnecessary fire drill here. I'm more than happy to take calls and to talk to companies about their options and next steps. But this reform is substantial. It updates a rule that really hasn't been touched for the last 3 decades, as far as I can tell. But by removing the piggyback eligibility, it's basically saying that without disclosure, thank you. Without disclosure that the SEC would like to have companies provide, companies just cannot be quoted here for continuous quotation. And so by being on QB or being on QX, I mentioned that all companies on those markets are posting materials to our system. That meets the needs. And so QB and QX clients are exempt from the overhaul of this rule. But come Q3 of next year, many companies will need to have determined whether they're going to post disclosure and continue to be quoted in the US or risk losing public quotation. So I believe there'll be some exemptions. Possibly if you're in the FTSE All World, that's potentially an exemption. We're really working as hard as we can to get as many exemptions as possible, but I suspect that most companies in Canada will have to take a close look at this and determine the course of action. Thank you. I think that concludes my speaking spot. I'm sorry I've run over a little bit, but hopefully I've proactively answered any questions that might have come up. I'll hand over to you, Chris and James.
All right, so you've heard the pitch and you've decided that the OTCQX or OTCQB is where you want your company to go and to be quoted and available for US shareholders. we're now going to talk about what are the listing criteria that you have to satisfy in order to be eligible to be quoted on one of these two markets. We're going to focus on the largest category of cases for Canadian companies, which is that the vast majority of Canadian companies will qualify under the standards that are applicable to a company that is a foreign private issuer and that is already listed on a qualified foreign stock exchange in Canada. And the exchanges that qualify for that status include the TSX, TSXV, the CSE, and the NEO Exchange. If your company or the company that you work with is not a foreign private issuer or is not traded in Canada, feel free to reach out to one of us after the presentation. There are other listing criteria that could be pursued by other types of companies, but that's beyond the scope of today's presentation. We will, however, go through for these types of Canadian companies, what are the requirements for the OTCQX International tier and the OTCQX tier. There is, just as a note, an additional higher tier for billion-dollar companies, but as you can imagine, that tier is reserved for some pretty exclusive folks. All right, so first, what is a foreign private issuer? That is a status that is defined by SEC rules. It is defined as any non-governmental issuer that is organized under the laws of a non-U.S. jurisdiction. So any Canadian provincial company or Canadian federal company, as long as it's not governmental, should qualify, subject to an exception. And that exception is that you lose your foreign private issuer status if, as of the last business day of your most recently completed second fiscal quarter, you have two major U.S. nexuses. The first is that a majority of your voting securities are held by U.S. residents on a beneficial basis. And the second is that in addition to being majority U.S. owned, you have any one of the following. Either a majority of the company's directors or executive officers are U.S. citizens or residents, or a majority of the company's assets are located in the U.S., or the company's business is administered principally in the U.S. And just to be clear, you have to fail both of these two larger bullets in order to lose your foreign private issuer status. So for some companies, if you know your assets are not majority in the U.S. and you manage your list of directors and executive officers so that you never have a majority of either of those that are U.S. citizens or U.S. residents, then you're fine, and it doesn't matter how much of your company is owned by U.S. residents. Conversely, if you're a company that does have a U.S. business, say you have a U.S. cannabis business, or you are a mining company with your principal operations in the U.S., or a tech company with your technology and assets in the U.S., then you've got to put a lot more focus on your ownership and making sure that you don't have a majority of your voting securities held by U.S. residents. And for purposes of that test, a voting security is any security that has the right to vote in an election of directors. And if you are a company that has more than one class of securities that can vote in an election of directors, then the SEC will allow you to run that test either by counting voting power or by counting the number of securities. All right, so in addition to being a foreign private issuer, the company is listed on an exchange in Canada, And then the company has to either be exempt from SEC reporting, or it can be an SEC reporting company or a Regulation A reporting company that files reports with the SEC and that is in compliance with its obligations. Because the OTC markets are typically sought after by companies that are trying to expand their exposure to U.S. markets without becoming SEC reporting, it's usually this exemption from SEC reporting tier that companies are qualifying under. And what does that exemption require? So for a company that has been trading in Canada for some time, we have an exemption that Chris King had mentioned called Rule 12G32B. And that's an SEC rule that says that generally a company is not required to register with the SEC if it's a foreign private issuer, if it is traded in a non-US market. That trading market has to constitute the primary trading market for the securities during the most recently completed fiscal year. And the way that you demonstrate that it's your primary trading market is that at least 55% of worldwide trading in the security has to occur on that market. If you want, you are permitted to add a second country, a non-US country. So if Canada plus one other country added up to 55% of worldwide trading, that would also qualify. And then the last requirement for this exemption is that all material disclosures that you make public or to your shareholders have to be filed on a particular website and have to be filed in the English language. And typically your CDAR filings would satisfy that requirement. Now, some companies can't qualify for that 12G32B exemption. Typically, the reason is that they have not been trading in Canada for long enough, because the 55% test is based on the test in your most recent fiscal year. So a company that has just gone public in Canada, they may not have had any trading in their prior fiscal year. And in that case, the exemption from SEC reporting would be the same one that any US company would rely on. You would be exempt from SEC reporting as long as you have never had, at the end of any fiscal year, more than 2,000 holders of record of your shares worldwide, and you have not had, at the end of any fiscal year, more than 500 holders of record worldwide that are non-accredited investors. And typically companies pre-IPO can qualify for that exemption because it's rare that a pre-IPO company would have more than 500 shareholders. Company must also have quotes published in the OTC by at least one market maker. James will talk a little bit later in the presentation about the process for getting market maker quotes. As Chris had mentioned, a Form 211 form has to be filed with FINRA by that first U.S. broker-dealer. Both of the tiers also require that you have at least 50 beneficial shareholders holding at least 100 shares each. The company cannot be in bankruptcy. So as Chris mentioned, that distinguishes from the pink market where companies might be in bankruptcy. And the company's transfer agent has to participate in what the OTC calls the Transfer Agent Verified Shares Program. That is not usually an issue because the major Canadian transfer agents participate. Okay, now here's where you figure out, are you a company that's able to be quoted on the higher level OTCQX market or only the OTCQB market? And there's really three things that are usually the cause of having to apply for the QB instead of the QX. The first is this QX requirement here that the stock cannot be what is called a penny stock as defined by the SEC. You have to qualify under one of these exemptions. And the one that's most typically available is one of these first two bullet points based on a net tangible asset test. So you can qualify by having net tangible assets of at least $5 million US, or alternatively, if your company has been in continuous operation for at least 3 years, you only have to have net tangible assets of $2 million US. In both cases, this test has to be demonstrated by audited financial statements that are your most recent audited financial statements. So sometimes if a company has only exceeded these requirements after the end of their fiscal year, you could potentially audit your more recent interim financials to satisfy the test, but otherwise it's your audited financials. And what are net tangible assets? So net tangible assets is calculated by including all of your assets on your audited balance sheet, but then subtracting out any intangible assets like goodwill or patents, and then also subtracting out your liabilities. There are two additional exemptions that I mention here based on revenues or share price, but they are really rarely used. One last point here, continuous operations for 3 years. So that is not defined in great detail as to what that means, but the SEC has been clear that a shell company is not considered to be in continuous operations. So, if you have a company that was a CPC or shell and only ceased to have that status less than 3 years ago, then it would be the 5 million threshold that you need to satisfy. The OTCQX also has minimum bid price and capitalization requirements. Company must have a minimum closing bid price of at least 25 cents US and a market capitalization of at least 10 million US, and has to have ongoing operations. You can't list on the QX if you're a shell company. So if you can't satisfy one of those requirements, then you would next look to the OTCQB. And the good news is that almost all foreign private issuers that trade in Canada can meet these QB requirements. The minimum closing price requirement is only 1 cent US. You have to have audited financial statements. You must be in good standing. And then there's a relatively new requirement that at least 10% of the shares that are outstanding have to be considered to be in the public float, which the OTC explains means that the shares are not subject to any resale restrictions, and they're held by persons other than directors, officers, 10% shareholders, and their affiliates and family members. And the OTC also has the ability to waive this 10% requirement as long as the company at least has 5% of its shares in the public float. So basically, most Canadian publicly traded companies will be able to at least apply on the QB, if not the QX. I'm now going to turn things over to James, who is going to talk us through the process of actually doing the application. What do you need to do? How do you do it? Go ahead, James.
As part of the application process and part of the OTCQX or QB listing process, an issuer needs to engage a sponsor. And a sponsor can be a qualified attorney or investment bank. The OTC website has a list of the various entities that are qualified to act as a sponsor. The sponsor will assist the issuer with completing the application. The sponsor will shepherd the application along with the OTC. They'll answer questions that the OTC may have about the issuer and the issuer may have about the process. At the end of the process, the sponsor will submit what's called a letter of introduction, which verifies that the issuer meets the listing requirements. All issuers need to engage the sponsor, except there are some exemptions, and those are for issuers that are on national stock exchanges and that are moving to the OTCQX or QB. So, issuer on NASDAQ or NYSE or NYSE American who's moving is not required to get a sponsor. And the same thing for an issuer that's currently on the OTCQX and is moving to the OTCQB, or vice versa. Dorsey has assisted over 150 Canadian issuers with their OTC listings, acting as sponsor. We've also assisted some of the investment banks with their sponsor programs, and we've also assisted other foreign and US companies with this process as well. So moving on, next slide. So once you've engaged your sponsor, the next step is submitting an application, whether it be the OTCQX or OTCQB application. There's some basic information that's going to be needed about the issuer, its officers, directors, and 5% shareholders. A background check authorization form will need to be submitted, as well as a registered shareholder list and NOBO list. You may be required to submit personal information forms. In some circumstances, the Canadian forms may be reused if you've got recent ones. Otherwise, you may need to use the OTC's form, as well as completing an OTCQX agreement, which lists the obligations between the issuer and the OTC. The OTCQB has its own agreement, but that's included as part of the general OTCQB application. Once the application is submitted, an issuer will need to pay the application fee, which is $5,000 for the OTCQX and $2,500 for the OTCQB. The application fee for the QB is increasing on January 1st to $5,000. So if any issuers are interested, it may make sense to start that process, complete the application, and submit the application fee by the end of the year. Separately, while the application process is ongoing, the issuer needs to ensure that it has a market maker. And so if an issuer is not already quoted on the OTCQ Pink, the OTC Pink by a market maker, then a market maker will need to file a Form 211 with FINRA. And so market maker is a US broker dealer registered with FINRA. The market maker will need to undertake a certain level of due diligence, and then will file the Form 211 with FINRA to start the quotation. And that quotation allows the issuer to start trading on the OTC Pink, and then subsequently to the OTCQB or the OTCQX. The market maker and different market makers have different diligence requirements. So sometimes that process can take a couple of weeks. Other times it could take a couple of months or longer, depending on the market maker's internal procedures, as well as FINRA's procedures and how busy everybody is. That quotation is generally a piggyback off of the Canadian trading. So the quotation kind of matches what's happening in Canada. Next slide. So once the OTCQX or QB application has been submitted, the application fee has been paid, the OTC will undertake an initial review to ensure that the issuer is eligible, as well as do some initial due diligence. At that point, the OTC will open up the OTC's disclosure website called the OTCIQ, which will enable the issuer to upload certain disclosure documents that needs to be made available on these web portals. So for an OTCQX company, what's required to be uploaded is the last 3 years of annual filings. So Canadian AIF, annual MD&A audited financial statements, any subsequent interim financial reports, and other material disclosures that were made pursuant to Rule 12G32B since the most recent annual report. So that most recent AIF, MD&A audited financial statement. And what are these disclosures that would be required to be uploaded? And so it's disclosures that the issuer has made public pursuant to its home jurisdiction, has filed with its principal stock exchange, and was required to be made public, and has been distributed to its security holders. So generally speaking, it's disclosure that a Canadian company has filed on FEDAR, has filed with the CSE and been made public by the CSE, or distributed to its security holders. Next slide. For OTCQB companies, what's required to be uploaded is the last 2 years of disclosure documents other than press releases. In addition, there's one additional document that needs to be prepared, and that's the OTCQB certification. That certification includes some basic information about the company, the list of the attorneys who assisted with the preparation of the company's annual reports, any third parties that were engaged by the company, its officers, directors, controlling shareholders, or promoters to assist with investor relations activities, public relations activities, etc. In addition, the issuer is required to list any outstanding promissory notes, convertible debentures, other types of debt securities, and list any note holders. So that's additional disclosures that wouldn't otherwise be required in Canada. Additionally, you list out officers, directors, and 5% shareholders and their shareholdings. Material change reports are required to be uploaded to the OTCIQ. So that's something that, even though the press release itself wouldn't have been required, a material change report is something that is required to be uploaded. That's a question we received from the audience. Once the disclosure documents have been uploaded to the OTCIQ, your sponsor will review them to ensure that everything has been uploaded properly. Once the Form 211 clears with FINRA, the sponsor will be able to submit the letter of introduction. The OTC will then complete a second level review to ensure that all of the listing requirements are met, that all of their due diligence is completed. At that point, the issuer will be asked to pay an annual fee, which is $23,000 for the OTCQX, which is prorated, $14,000 for the OTCQB, which is a 12-month period, which is paid up front. And then the issuer can pick the date that they'd like to start trading. For OTCQX listings, the OTC, as well as the issuer, typically will issue a press release the morning that the listing commences. Next slide. So a couple other considerations. Chris talked a little bit about Blue Sky, and I just wanted to touch base on that a little bit more. So Blue Sky that we're talking about is about secondary trading, and that a company must comply with state laws as a result of not being on a national stock exchange. So national stock exchange listed issuers don't have this consideration, but for OTCQX or QB companies, they need to ensure that they're exempt or registered in the state in order to permit brokers in that state to solicit or advise a client to purchase a company's securities. So there's no prohibition if a client calls up their broker and says, I want to buy or sell a security. The concern here is that a broker can't actively say, you should buy this, the issuer stock. Another consideration as part of the OTC listing process is the depository trust company. So DTC is similar to CDS in Canada. It facilitates the electronic settlement of trades. In order to obtain DTC eligibility, you need to get a DTC participant to submit the application. And so you may go through your transfer agent, or you may need to engage a service provider in the United States to assist with this process. You may also need to engage a US transfer agent. Part of the process that sometimes gets a little tricky is that DTC requires a PDF copy of a physical share certificate that's held by someone who's not an affiliate and doesn't have any transfer restrictions. In today's day and age, most people hold their securities in CDS, so they don't have physical share certificates. So that is something that needs to be obtained as part of the process. Additionally, as part of the DTC process, the issuer will require a legal opinion from US counsel. So that is certainly something that Dorsey can assist with. We've assisted many issuers with their DTC eligibility process, as well as the legal opinion. Now, Chris Dirksen is going to take over a little bit and talk about the continued qualifications and requirements as part of trading on the OTCQX or QB.
Thanks, James. Looking at the time, looks like we won't have time for Q&A at the end. If anyone has submitted questions already that have not been answered, we will try to reach out to you after the presentation, and I will try to handle this last section quite quickly. So after you're quoted, there are some continued qualification standards. For the OTCQB, you have to continue to meet the same standards for your initial qualification, including the 1 cent trading price. For the OTCQX, there are a few breaks given. For continued qualification purposes, the minimum price is reduced from 25 cents US to 10 cents US, and the minimum market price, minimum market capitalization is reduced from 10 million US to 5 million US. There's one additional requirement that once you've been quoted for 90 days, you need to have 2 market makers making a market in the stock, but that typically occurs naturally, and that's not usually an issue for people. The company would also have to comply with applicable laws and OTC rules, including continuing to make its material disclosures through the OTC Disclosure News Service that James had described. In practice, what this means is that whenever you do a material filing on SEDAR, like your quarterly and annual filings, your circular, your material change reports, in addition to filing them on SEDAR, you would file them on the OTC website as well. A few additional requirements. James mentioned the annual fees. OTC also has a policy prohibiting any inappropriate stock promotion. If there's a change in control of the company has to provide notice to the OTC and generally must submit a new application to continue to be quoted after the change of control. The QX requires a notice if there is a change in the auditor. The QB requires a notice and prompt public disclosure whenever there's any new convertible debt taken on. And the QB also requires an annual compliance certification form. And while generally speaking, a company does not need to become an SEC reporting company by virtue of being quoted on the OTC, there are a few SEC considerations to be aware of. First, just want to dispel the myth. We often hear companies that assume that by qualifying on the OTCQX or QB, that will automatically cause all outstanding shares to become free trading in the US, or sometimes the assumption that now that you're listed, you no longer have to qualify for exemptions to do private placements in the US. That's not the case. The OTC, QX, and QB are markets for trading shares that are already eligible to be traded, and it doesn't accelerate any hold periods or anything like that. Second, as I mentioned, the foreign private issuer test has 2 parts to the test, one of which is whether a majority of the voting securities are held by US residents. If you're a company that is relying exclusively on that part of the test to remain a foreign private issuer, you will want to track your US ownership on an ongoing basis to see if there's any risk that you're going to become majority US owned. As I mentioned, though, there is a second part of the test, so that is not always an issue. It's only an issue if you also have majority US assets or a majority board or executive team. Third, you'll want to track your trading volumes on the OTC QXQB versus Canada and other markets. This is not normally a problem for a TSX company or for a TSXV company, but sometimes we see companies that are listed in Canada, say only on the CSE, might find that over time, trading in Canada becomes less than 55% of worldwide trading in a fiscal year. And if that occurs, that could affect whether the company is required to become an SEC reporting company, depending on the number of record holders of shares that it has. And it could also affect the requirements for what US rules you have to follow when you're doing issuances of securities. Lastly, the SEC has one disclosure rule that applies to non-reporting companies, Rule 10b-17. And that rule applies to anyone traded in the United States, and it requires that the company provide notice to FINRA 10 days prior to the record date if the company plans to do any dividend, stock split, or rights offering. So we are out of time here. Let me just try to capture a couple of questions. So question about majority ownership of the company in the US. It is based on residency, and so for the purposes of that test, if you have a US citizen resident in Canada, they would not count as a US owner for purposes of the ownership test. And then we also had a question about how do you track US ownership. If that part of the test is what you are relying on, what the rules officially require is that you take into account all information that you have access to, but you also have to look through the ownership by CDS, DTC, nominees, brokers, banks who act on behalf of third parties. And so to officially know for sure when you're close to the line, what you really have to do is order a beneficial ownership search in Canada and in the US. That's something that your transfer agent can typically arrange at relatively low cost and can be completed in a week or so. So apologies, I think we're out of time for additional questions, but we will reach out to you if you have asked a question that we have not answered. Thanks everyone for joining today. Hope this was useful to you, and feel free to reach out to Chris or to James or myself if you have any further questions, or if you'd like to talk to any of us about getting quoted on the OTCQX or OTCQB.